Welcome to our breakdown of the PMI versus investing dilemma, often called the 6% trap. First, we'll frame the challenge. Should you eliminate private mortgage insurance to capture a near-guaranteed return? Or should you invest to chase higher long-term market gains? Next, we'll highlight the core trade-off between safety and growth. Then, we'll map out a decision framework you can apply immediately, with examples, diagrams, and quick calculations. Finally, we'll test your knowledge with a couple of quick quizzes and end with a simple action plan. As we transition, keep your personal situation in mind, especially your cash flow, risk tolerance, and emergency fund. Here's our roadmap. First, we'll define PMI and why it exists. Next, we'll quantify the 6% trap and why it can be thought of as a guaranteed return. Then, we'll confront the crucial liquidity versus equity trade-off. After that, we'll compare a 6% guaranteed outcome with a potential 10% market return. We'll then walk through a decision framework and a real-world case study. Finally, we'll wrap up with a clear action plan, 2 short quizzes to cement learning, and a concise summary with next steps. Let's begin with PMI basics. Before we proceed, a quick disclaimer. This content is for educational purposes only and should not be considered financial, legal, or tax advice. Your personal situation, goals, risk tolerance, and local regulations matter. Therefore, consider speaking with a licensed professional who can tailor advice to your circumstances. With that said, let's move confidently into what PMI is and how it affects your bottom line. Private mortgage insurance, or PMI, is a lender protection policy that borrowers pay when they put less than 20% down. Its cost varies, but it's commonly in the range of roughly 0.33% to 1.5% of the loan annually, paid monthly. The key is that PMI is removable once your loan-to-value ratio drops to or below 80%, either through regular amortization, extra principal payments, or a new appraisal if your home value has risen. Eliminating PMI has 2 benefits. It increases your monthly cash flow by removing the premium, and it can represent a relatively certain financial return because you're reducing a known, recurring cost. With that foundation, let's quantify the 6% trap. When people refer to the 6% trap, they're simplifying the idea that paying down your mortgage's principal, especially to remove PMI, can deliver a near-guaranteed return roughly equal to your mortgage rate plus the eliminated PMI cost. For example, if your mortgage rate is 6.25% and you're paying about $150 per month in PMI on a $350,000 loan, the effective benefit of accelerating payoff toward the 80% loan-to-value mark can approximate a 6% or higher return. Crucially, once the PMI drops off, your monthly payment decreases, improving your cash flow. This is why eliminating PMI is often framed as a risk-free profit. Now, let's compare this with the lure of a 10% long-term market return. On the left, paying down to eliminate PMI offers a near-guaranteed return and immediate cash flow relief. It also lowers your housing risk by reducing required monthly outflows. However, the downside is illiquidity. Once you tie up money in home equity, it's harder to access quickly. On the right, investing targets a higher long-term expected return, often around 10% historically, with the advantage of liquidity in many accounts. But investments fluctuate, and the outcome is uncertain. Plus, you'll still carry PMI if you avoid paying down the mortgage. Next, we'll turn this into a repeatable decision flow you can use today. This decision flow begins with liquidity. If you don't have 3 to 6 months of essential expenses saved, prioritize building that emergency fund. Next, if you have high-interest debt above roughly 6%, pay that off before considering extra mortgage payments. Then, evaluate your effective rate. If the mortgage plus PMI cost is around 6% or higher, paying down to reach the 80% loan-to-value threshold can be attractive. Once PMI is removed, redirect the freed-up cash flow back into your investment plan. With the flow established, let's double-click on why liquidity matters so much. Liquidity often trumps equity in the real world. During a job loss or emergency, you cannot quickly or cheaply spend home equity without selling, refinancing, or tapping complex products. In contrast, liquid savings and accessible investments can cover your needs immediately. Therefore, avoid sacrificing your emergency fund or retirement contributions to chase PMI removal too aggressively. Your balance between stability and growth should reflect your risk tolerance, job security, and timeline. Now that we understand the liquidity priority, let's study a compact case comparison to see numbers in action. This simplified table contrasts three approaches. In the payoff-focused scenario, you funnel $1,000 per month to principal, reach the 80% loan-to-value mark sooner, and remove PMI within about 8 months, improving cash flow by roughly $150 monthly thereafter. In the invest-only approach, you keep PMI for the full year but potentially grow a portfolio, noting the market could underperform or outperform 10%. The hybrid blends both. PMI drops later, but you maintain some market exposure. Assumptions vary by loan size, rate, PMI amount, and market performance. Next, let's translate this into a clear action plan you can apply. Begin by assessing liquidity. Confirm you have at least 3 to 6 months of essential expenses set aside. Next, list your debts and pay down any interest rates above roughly 6% before tackling PMI. Then, compute your effective rate by combining your mortgage rate and estimated PMI savings rate. Determine the dollar amount needed to reach 80% loan-to-value and consider a plan to get there. Automate your retirement and taxable investing so contributions remain steady. Once PMI drops off, redirect the freed-up monthly premium into your investments to accelerate compounding. Finally, reassess quarterly and watch for appraisal opportunities that could remove PMI sooner. Now, let's check your understanding with a quick quiz. Quiz time. Which should generally come first before aggressively paying down PMI? Option A. Maxing out a taxable brokerage account. Option B. Building a 3 to 6 month emergency fund. Option C. Paying only minimums on 22% APR credit cards. Option D. Skipping retirement contributions entirely. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is building a 3 to 6 month emergency fund. Liquidity comes first because it prevents you from being forced into high-interest debt or selling investments at an inopportune time when emergencies occur. With that confirmed, let's visualize how you might allocate monthly cash once the fundamentals are in place. This pie chart offers a sample allocation once you've stabilized your cash foundation. In this example, 20% tops up the emergency fund as needed, 30% targets any remaining high-interest debts above 6%, 30% supports retirement accounts, 10% goes toward PMI paydown, and 10% remains flexible for lifestyle or buffer needs. These percentages are illustrative. Customize them based on your risk tolerance, job stability, tax advantage space, and how close you are to removing PMI. Now, let's try one more quick quiz to reinforce the investment side decision. Second quiz. When is prioritizing market investing over PMI paydown most logical? Option A. When you have no emergency fund but want higher returns. Option B. After your emergency fund is secure, high-interest debts are gone, the effective PMI rate is below 6%, and you can tolerate volatility. Option C. When PMI is very expensive and your mortgage rate is low. Option D. When you plan to sell your house next month. You may pause the video now to consider your choice. We will discuss the answer in the next section. The best answer is to prioritize market investing after your emergency fund is established, high-interest debts are eliminated, your effective PMI-related rate is below about 6%, and you can tolerate market volatility. This aligns with maximizing long-term returns while respecting risk management and liquidity. Next, we'll reinforce the main principles with concise takeaways. Here are quick formulas to make decisions concrete. The effective guaranteed return is approximately your mortgage rate plus the PMI savings rate you'll capture by eliminating PMI. The 80% loan-to-value target equals 0.8 times the current appraised value. The equity needed is your current loan balance minus that target. And your monthly cash flow boost roughly equals the PMI payment you eliminate. Always verify removal criteria with your lender and explore appraisal options if your market has appreciated. Now, let's consolidate everything into a concise set of takeaways. To summarize the main points, prioritize liquidity by building your emergency fund first. Treat high-interest debt above roughly 6% as a priority because it drags on wealth. If your combined mortgage and PMI cost is around 6% or higher, eliminating PMI can represent a near-guaranteed return and an immediate cash flow improvement. Nevertheless, do not starve your retirement investing. Balance both goals as your situation allows. After PMI falls off, redirect the saved dollars into your investments to accelerate compounding. Next, we'll close with a brief summary and your next steps. In closing, eliminating PMI is financial hygiene that often yields a stable return and better cash flow. While a 10% market return can be compelling, volatility and timing risk can undermine short-term outcomes. Liquidity is more valuable than equity in a crisis, so build protections first. Follow the decision flow. Secure your emergency fund, pay off debts above roughly 6%, evaluate your effective mortgage plus PMI rate, and then decide between PMI paydown and investing. Revisit your plan quarterly and adjust for changes in rates, home values, and your income stability. Finally, let's end with a quick thank you and a call to action. Thanks for watching. If you found this useful, please like the video, share it with someone comparing PMI payoff against investing, and subscribe for more practical money frameworks. In the comments, tell us your plan. Will you eliminate PMI first or prioritize market gains, and why? Your perspective may help someone else make a better decision. See you in the next video.